In the previous week, rupee maintained a weaker undertone against the dollar, the high and low for the week being 74.18 and 74.8650 respectively. Additional fiscal plan, higher oil prices, stronger dollar demand, and virus variant concerns puts the rupee lower to end the week at 74.74. The markets are keenly watching for any news on the timeline of tapering by Fed. We expect to see more currency volatilities in the market in the coming months, and recovery in the rupee exchange rate to 74.20 level or so should be utilized by the importers to hedge their payables up to 3-month maturities. The tapering by Fed before the end of 2021 or even earlier will only be for the partial amount of out of the total bond purchased of USD 120 billion in each month. This will lead to another bout of rupee weakness, possibly testing the next support at 75.30. The active intervention from RBI is definitely expected to come in at the above mentioned support level to avoid any panic buying by the market participants and the offshore entities. Exposure management is very crucial to recognize the currency risks and quickly reacting to achieve acceptable hedge ratio for hedging the current and capital account liabilities during the phases of currency volatility. However, the central bank with its huge forex reserves will be in a strong position to curb the rupee's weakness beyond the 76.20-76.50 level before the end of the current financial year. The currency volatilities and weakness in the home currency observed during the taper tantrum in 2013 should be reanalyzed to ascertain whether repetition of such an event is possible in the current circumstances after recognizing the possibility of huge portfolio outflows from the system amid the position of huge forex reserves. The approach and strategies for hedging of medium and long-term payables to the desired or approved level will have to be in place much before experiencing the weakness in the domestic currency as per the conservative and calculative expectation expressed above. In June, rupee has depreciated by about 2.50% as a result of rapid rise in global oil prices and hawkish comments from Fed on tapering, which pulled down the rupee to breach the supports at 74.00 and 74.60 en route to its current level of close to 74.80. We expect to see an active and determined intervention from RBI to curtail the rupee's rapid fall in the background of the need to limit the imported inflation due to sharp rise in global oil prices impacting on the diesel and petrol prices. Rising oil prices and global risk-off sentiment could turn negative for domestic stocks, triggering the flows back to safe haven US. Crude oil prices continue to rise and oil companies are keeping the bid going on the US dollar and exerting pressure on the rupee. The higher crude oil prices and expectation of higher fiscal deficits could stimulate a gradual down move in the rupee. In the current circumstances, we recommend the importers to quickly act to hedge their near-term liabilities at the opportune time in a phased manner to avoid fixation of adverse exchange rates against import bill settlements falling due in the next 3 months period from now, as the market expects the strong resistance to hold at the 74.00 level. The exporters can target for the spot level of 74.80 to initiate selling of their medium-term receivables. Despite the weakness in the rupee exchange rate, the forwards have dipped lower across the maturities, more pronounced in forward dollar premium levels up to 6-month maturities. The 3-month and 6-month forward dollar premium is currently quoted at 4.10% and 4.20% per annum respectively. The forward market differential between the 3-month and 12-month maturity is at 0.35% per annum, and the forward curve is demonstrating a steepening pattern at the long end.